Welcome back. Our next guest on the show is Jitendra Gohil, Chief Investment Strategist at Kotak Alternate Managers. Jitendra, good to have you on. So the market's been dealing with a bit of a correction, something it's not quite used to. And the question is, is the bulk of it done? Earnings season is obviously very mixed, as one would imagine. But what do you think? Is most of the selling over?
Hey, hi, Surbhi, and thank you for inviting me on your show. I think major part of this correction is led by FPI selling, right? So we have seen humongous amount of selling that has happened, but the market remains around 5 to 6% below, at the beginning of the month. I feel that this FPI selling is the major, concern for the market. Domestic flows are pretty much stronger. So we have been recommending investors to stay invested. We believe that, the earnings growth is slowly slowing down, almost 13%. What we were expecting, it's slightly lower than that. But we think that upcoming festive season, then you have better monsoon. Government has been pretty slow in spending so far after the elections. And we think that the government spending might pick up. Also, the RBI has changed their stance from withdrawal accommodation to neutral. So net, I think if you look at going ahead from a 3 to 6 months perspective, the outlook is going to improve going forward, and hence we think that this correction probably may not last longer. And this was much needed correction, I would say. The kind of valuations that we have seen in small and mid caps, I think this is a healthy correction. We just have to focus on fundamentals, and there are various opportunities available looking at 2 to 3 year perspective.
So can you talk, Jitendra, about the various opportunities? If it's time to stay invested, if you had 100 rupees, how would you deploy it?
So, see, we are asset allocators. So in our think tank meeting, we discuss asset allocation outlook. So we think that from a hedging perspective, the best asset class, I would say, is equity and gold. Going ahead, I think one has to look at rise in inflation. We don't know how US elections will pan out. Global inflation has been surprising on the downside, but slowly now looking at China stimulus and plus Donald Trump, if he comes to power, his policy seems to be inflationary. So we have to hedge our portfolios based on these kind of uncertainties. And hence we think that gold, we remain pretty bullish. We think that metals, especially gold, can do better. Silver is a strategic, I would say, not a strategic, but a kind of a tactical bet. But I think precious metal, where we remain a little bit more positive. Coming to equity market, I think we have to identify sectors which are emerging. Now, in the broader market, you find several odd sectors. We think going ahead in the next 3 to 6 months, some of the real estate companies have corrected significantly. As the interest rate cuts was expected to be around 50 odd basis point in US, another cut. But now market has, pricing in almost 25 bips rate cut. And also from India's perspective, rate cut cycle is a little bit pushed back. So some of the real estate companies have corrected. So I think that there one can look at investing from a 6 months to a year perspective. Similarly, now, if you look at the rural side, slowly, gradually, we have seen some rural plays have started to pick up. And I think consumption has been beaten down. Market was expecting some recovery, but it's not happening anytime soon. But these stocks have corrected. And I feel that in the next 6 to 9 months perspective, this correction should be used as a buying opportunity. So I would go into real estate. I will look at some of the consumption names which are beaten down. Thirdly, the financials, right? So as the economy grows, I think there will be more and more opportunities for the financial sectors. So far, the valuation is still reasonable compared to the market. NIMs have been coming down. Growth has been slowing down. But I feel that this is the kind of time where we should invest in these kind of sectors. So banking, financials, where we like large private sector banks, they've started reporting results, and we have seen most of the worst scenarios have been largely priced in. And I would suggest that barring the microfinance or unsecured loan, I think a large part of the banking stress is behind. And I think going ahead, I think one should look at buying some of the financials.
Okay. Hi, Jitendra. Good afternoon and good to see you. And if you could put a percentage to the asset allocation, gold, equities, as of now, bonds, if you could put a percentage. And within equities, I recall earlier this year when we had a chat, you were talking about, I think, 70-80% going into large caps. Currently, would you stick to that?
Hey, Nigel. Hi. Yes. I think, see, from commodity perspective, we have been talking about a 5 to 10% holding in gold. If I look at the equity and debt, it depends on the risk appetite, right? So, largely some clients would prefer to have everything in equity because they don't need money in the immediate 1 or 2 years perspective. So we generally recommend that, look, if you have any holding or any requirement in the next 1 or 2 years, we can look at having allocation to bonds. But a balanced kind of a portfolio, we recommend to build exposure in the higher duration bonds as our view that the yields are going to come off. Obviously, it will not come off very sharply, but slow and gradual grinding lower. So depending on the allocation or depending on the risk appetite, we allocate between equity and debt. But within equity, we believe that at least 70 to 80% should be parked in large caps. And that view continues. We feel that overall broader market perspective, we have booked profits in some of the stocks which have, gone to exorbitant valuation, where we are booking profits and slowly moving towards the large caps.
Okay.
Oh, wow. I think we're just losing that line with Jitendra, but that's the point that he's making, that there's a shift towards large cap. That's how they're looking at the portfolios now and looking at some interesting bets in the financials universe as well. Okay, so the market isn't doing too much. We're still looking at a very, very mild 13 point sort of a cut on the Nifty. That's how it's playing out. Not sure if we have Jitendra back. Do we have him back on the line? Okay, we don't have him back immediately. The weakest names today include, like I was saying, the names like M&M, Sun Pharma, NTPC, Power Grid, L&T is also not contributing today, and then the banks are very, very indecisive. So that's the issue with the banking space as well. Jitendra, I think we have you back with us. So you were making the point about the shift to large caps. So that's one clear trend. The other thing that we want to understand is that in this correction, obviously a lot of the PSU stocks have cooled off very, very rapidly. In general, I mean, CapEx was the leader of the rally, right, for the better part of it. What is your view on PSUs, CapEx, industrials? Have you been taking profits as well?
Yes, Surbhi, see, what we have to understand, these stocks were actually doing much better because of the government spending. So from March onwards, we have seen because of elections, government is going slow on spending. So capex spending has slowed down from the government, and also even revenue spending is slowing down because of the election. And slowly, gradually, we feel that looking at the PMI numbers, which have seen some minor slowdown, I feel there will be a pickup. And since the consumption is not picking to the extent the way market was expecting, there could be slight rotation happening towards the industrials and capital goods. It's not a clear sign as of now. We will have to wait for some data points, but slowly, gradually, I think some pickup will happen in the high beta, or you can say capital goods and industrial names. Second thing that you spoke about is what I think on the capital goods.
Yeah, on the industrial and capital goods side, yeah.
Yeah, so that's and in terms of PSUs, I think see the clear sign emerged after the elections, right? So market was betting that there will be a clear majority government, and we did not have that. So that was a pivot, and a lot of investors have started buying PSUs to the extent that some of the PSUs were actually trading at something like unheard of valuations. So I feel that correction is underway. So we are staying away from PSU as of now. We feel that there's more derating possibility as the valuation is still high. And secondly, I think market is also waiting for a clear outcome of the state elections. So I feel that's a near-term trigger. If we see positive results, or BJP retaining Maharashtra, then I think we might see more interest in some of the PSU or capex spending kind of stocks, because we have clearly seen that in the past government has tilted more towards social welfare spending if their political victory is not to the extent that they were expecting. So that's the view. I think it's a politics and PSUs go hand in hand, in my view.
Thank you, Jitendra, for joining in. Just one more